Welcome in. Over the next half an hour, we are going to take part in one of the most beautiful ideas in all of finance. And there's a picture at the heart of today's session, a single curved line. And once you can read that line, a huge chunk of portfolio management stops being memorization and it starts being obvious. You do not need any prior finance background if you are taking this session. If you can handle a weighted average and a square root, you have pretty much everything that you need to follow this session. So once again, welcome everyone. We are going to build everything that you need for this session grounds up. Now let us go and understand the overall frontier of this session. We're going to make 6 stops, and this is pretty much the entire map of this session. We start with a single asset, and we move on by combining assets. And once we start combining, and that is where we understand that how risky mixing two assets actually is, that when you combine two assets. So what actually happens when you combine two assets, and these two will lead us to the heart of this discussion today, and that's correlation. And we start discussing correlation, and that's the heart of the engine that we are discussing today. From there, we go on to discuss the efficient frontier and then the risk-free asset. And finally, we land on systemic and unsystematic. The systematic and unsystematic, this is something that's another core aspect of this discussion, which we will be picking up at the end of this session. Now let's take example of two persons. A stock picker looks at the company and says, is this a good stock? Now, the stock picker is also an investor. And the question that arises in his or her head is this a good stock? While a portfolio manager is, when I pick this stock, what exactly is going to happen to my portfolio? And the difference is the entire session. This session is all about the perspective from a stock picker's point of view and from the perspective of a portfolio manager. Same stock, but a different cushion. Because here's what is making this discussion possible. Portfolio can be less risky than the average risk of the things inside it. So if I pick 4 or 5 different stocks and we bundle it up in a portfolio, the overall risk that we are going to take in that portfolio would be less than the individual risks which are there on a combined basis. An individual stock can never do that, but a portfolio can. So an individual stock could have a higher risk, but when you mix it with 4 or 5 different stocks in one portfolio, the overall risk could be a lot lower. And let us understand why. Step 1 is the return of a single asset. So now nobody knows what next year holds. So if as an investor or someone who's looking investing in different assets, nobody knows that how the future timeline is going to up. So instead of pretending we do, we lay out the possible worlds and weigh them by how likely each one is. So you could have multiple scenarios. Suppose we think there's a 25% chance of a boom. So that's the first scenario. So what we do is we are trying to estimate how the future is going to be. We estimate multiple scenarios and we estimate the returns for multiple scenarios. So say, for instance, we look at the first situation, first scenario, over the next 1 year, we expect the probability 25% there could be boom. And if it's a boom, it's a 30% return. The base case, supposedly, there is not much of a difference in the situation between this year and the next year. It's a 50% probability. The return could be 10%. The contribution is 5%. And downturn, we might end up losing 10%, and the probability of this happening is 25%. So what exactly you end up doing is you take a combination, you multiply the scenarios with the kind of returns which are there, you sum it up, and that is what you are expecting it overall. Now, this is not the number you're going to make. You have multiply the return by probability. You are estimating what could potentially happen in each of these situations, and you end up at 10%. This we are saying is an expected return, and it is genuinely misleading. 10% is not what we think will happen. When you start looking at the chart, let's look at the chart here. And you're seeing a downturn wherein you see 10%, and then you look at the base case wherein you have 10% positive, and then you have a boom scenario wherein you have a 30% positive. When you look at the heart, 10% is it is not even one of the three outcomes. It is the center of gravity of everything that could happen. That's the balance point. And that raises the question that makes this whole session possible. How far from that balance point might we lend? So now we're thinking about a curve. And that is why statistics happens to be one of the subjects that is there at CFA Level 1. And it has huge advantage if you understand statistics. So what we have done, we're trying to estimate the expected return in a portfolio when you have multiple situations. In this case, you have taken three situations, and then you look at the scenarios. Overall expected return 10%. But when you look at the graph, what you end up here with is none of those, this base case of 10% or this 30% or this negative 10% overall gives you an expected return of 10%, but maybe all of these may not really be true. You might end up somewhere, and that is where the variance and standard deviation comes in. So how far might we lend is what risk means in finance. So you have an expected return, which you saw 10%, but how far would you be landing when compared to this 10%? And that is what I want to correct something right now, because almost every beginner arrives with this in their head. Risk is not the same as losing money. In this framework, risk is dispersion. It is the spread of outcomes around the average, and that means an unexpectedly enormous gain also counts as risk. And this might sound very counterintuitive, and it feels strange, if you are somebody who is getting introduced to portfolio management for the first time, an unexpectedly enormous gain could also count as risk. So now the spread that I've been talking about, how do we measure spread? Take each outcome's distance from the expected return. The boom is 25 points above. The base case is bang on. The downturn is 20 points below. Square each of these distances. Squaring kills the minus sign and punishes the big misses header. And that is what we're doing here in this situation. We get 200, and that's the variance. This is what you're getting here as the variance. Variance is a brilliant working number, but it's a terrible number to say out loud because it is in squared percentage points, which means nothing to a human. So we take the square root. And once you take the square root, 14.1%, that's the standard deviation. And now we are back in the same units as our return. And let's start looking on the chart on the panel onto your right. Two assets, same expected return, different spread. Low risk asset, 5%. High risk asset, 25%. So you have two assets, identical expected return of 10%. One clusters tightly, one is scattered all over. Same average, widely different experience. That difference is the standard deviation. And from here, I will just call it risk. And that is how we define risk when we try and study portfolio management. Now, I'm going to put two building blocks. And this is where the fun starts. Let's look at two assets. You have asset A, which is a growth equity fund, and then you have asset B, which is government bond fund. Now, asset A is a growth equity fund, expected return 14%, risk 20%, high reward, high volatility. And then asset B is a government bond, expected return 6%, risk 8%, calmer on both counts. So on the expected return, standard deviation, a lot more calmer. Now, before I show you anything, let's predict. If you put half your money in each, what do you get? And most people would say half the return and half the risk. 10% return, 14% risk. It's the intuitive answer. And on return, that intuition is perfect. So when you talk about on the return, your intuition is perfect. 10% is exactly right. On risk, that is where we are wrong. Not slightly wrong, meaningfully, usefully, profitably wrong. So what happens? Return is linear. So if you look at the return part, the return is linear. Risk is not linear. And here's the picture that proves it. Along the bottom, the fraction of your money in asset A from 0 on the left to 100% on the right, up the side, the risk of the resulting portfolio. The gray dotted line is what everyone expects. So this is the line where you actually want yourself to be somewhere on this line. Now a straight line, so that's the gray dotted line, a straight line from 8% on the left up to 20% on the right, the simple weighted average. But the blue line is what actually happens, and it sags initially, bows away from the straight line downward across the entire range. Go to the middle, 50-50. The straight line says 14% risk. The blue line delivers 10.8, 3.2 percentage points of risk gone. Now think about what you had to do to get that. You didn't forecast anything. You didn't time the market. You didn't find a mispriced security or outsmart anybody. You just held two things instead of one, and the risk fell. This is the closest thing to a free lunch that finance has, and it's the reason the profession exists. Now, why does it happen? Because asset A and asset B don't have their bad days on the same day. When one is down, the other is often flat or up. They partially cancel each other out, and crucially, return cannot cancel out because a return is just a weighted average and always will be. But risks can. That asymmetry is the whole game. Now, look at the left end. Look closer at the left-hand end of that curve because something genuinely strange is happening there. You start with 100% in asset A, the bond fund, the safe choice, 6% return, 8% risk. This is what a cautious beginner does. Now you take 14% of that money and move it into asset A, the risky one, the 20% volatility one. Your return goes up from 6 to 7.1. No surprise, you added a higher returning asset, but your risk also goes down from 8% to 7.4. More return, less risk is strictly better in both directions at once. Say it plainly, adding a riskier asset to your portfolio made your portfolio safer. And you need to run this in your head because you're adding a riskier asset to your portfolio and you're making your portfolio safer. That sentence should feel wrong. It should feel like I have made an arithmetic error. I haven't, and the reason has a name. One number that controls this entire effect, and that is correlation. And let's get a bit of correlation here. Correlation measures one thing only. Do these two assets move together? It is always between -1 and +1. It has no units, and it is a single number that decides how much diversification you actually get. Three cases, you look at the panels. On the left, correlation of +1, perfect lockstep. Asset A goes up, asset B goes up. Asset B goes up every time in exact proportion, and you look at those dots, a perfect straight line, and if two things always move together, holding both is the same as holding one, but you're holding it twice the quantum. There is no diversification here, zero. This is the worst case. In the middle, you have correlation of zero, no relationship whatsoever. Knowing what asset A did tells you literally nothing about asset B. You look at the scatter, no pattern at all. And this is where diversification starts doing real work because their bad days land on different days. And this is where, on the right, correlation of -1. A perfect mirror. One goes up exactly as the other goes down. And here we will see this in a moment. Risk can be driven all the way to zero. Now, real markets. Two random large cap stocks typically sit somewhere around plus 0.3 to plus 0.8. Positive, they do tend to move together, but nowhere near +1. And that gap between what you actually get and +1 is where every rupee, dollar, and euro of diversification benefit comes from. Now let's look at the formula, the two asset variance formula term by term. So asset A on its own, so we are piecing this formula together. Portfolio variance equals weights of A squared times A's variance plus weight of B squared times B's variance plus 2 times both weights times correlation times both the standard deviation. Now, term one is asset A on its own, its risk scaled down by how little of the portfolio it occupies, always positive. Term two is exactly the same for asset B, also always positive. And the third, which is the interaction where everything is happening. It's the interaction term, the only place the two assets actually meet, and it is the only term that can be negative because correlation can be negative. Terms 1 and 2 can only ever add risk. Term 3 can subtract it. So here's your one-line summary of portfolio theory. Term 3 is the entire story. Neutralize it, correlation of 0, and risk falls. Reverse it, correlation below 0, and risk applies. And I want to give you two exam warnings while we are here, and candidates lose mark on both every single year. One, that third term has 2 in front of it. Don't drop it. 2, this formula gives you variance, not standard deviation. You must take the square root at the end. Write both of those down. So let's make this concrete. Same two assets, same 50-50 split, 4 different worlds. The only thing changing is correlation. At +1, portfolio risk is 14%. That's exactly the weighted average, the straight line answer. Diversification delivered nothing. Drop correlation to 0, risk falls to 10.8, drop it to -0.5, 8.7, -1, 6%. And this is how you keep breaking down each of the components one after another. You start here, and as you move with the kind of correlations you have, you move down, you keep on reducing your risk. Now, here is a detail I really want you to notice. In all 4 of those words, the expected return is 10%, identical every single one. So same assets, same weights, same expected return, and the risk ranges from 14% all the way down to 6. If someone offered you those 4 portfolios, the choice isn't difficult. You would obviously pick the portfolio with the lower quantum of risk. And the general rule, which is worth memorizing, 14% is the ceiling. Any correlation below +1 puts your portfolio risk below the weighted average. Since virtually no two real assets are perfectly correlated, diversification is essentially always working for you. The only question is, how hard is it working for you? Now we'll look at a limiting case. And we are pushing it to the edge. Correlation of -1, that's a perfect mirror. At that correlation, you can do something remarkable. Choose your weights carefully. 28.6% in asset A, 71.4 in asset B, and the two assets cancel each other completely. Portfolio standard deviation 0, not low 0, and you still collect an expected return of 8.3%. Now, two honest caveats because I'm not going to oversell this. First, and you need to Remember this. First, perfect negative correlation essentially does not exist in real markets. So if you're chasing a perfect negative correlation, it is a tough call to really identify. This is a textbook boundary, not a strategy, and you shouldn't leave this session hunting for -1 pairs. It is more of a theoretical understanding. Second, and this is why it is worth the 2 minutes, it fixes your intuition permanently. Diversification is not about owning more things. You can own 50 stocks that all crash together and you have diversified nothing. Diversification is about owning things that behave differently, and behavior is what exactly we're looking at. The behavior is different. Now, the risk return space, and we change here, and how we draw this. This is the picture you will see for the rest of your CFA life. So let's learn to read it properly. Along the bottom risk, the up, the up the side return, every dot on this chart is one portfolio, one specific combination of weights. Down here, bottom left, that's 100% asset B, 6% return, 8% risk. Up here, top right, 100% asset A, 14 and 20, and the curve between them is every mix in between. Now, how to read this map? Up is good, that is more return. Left is good, that is less risk. So up and to the left is the direction every investor on earth wants to travel. So you want to travel up, but you also want to keep moving left. And now look at the shape of that curve. It doesn't run straight between the two assets. It bulges out to the left, it bends. If risk were a simple weighted average, this would be a straight line. It is not a straight line. That bend is diversification, and that is what we have drawn in this curve. Every bit of leftward bulge is risk that correlation removed for you. We have now seen the same fact three ways: as a table, as a formula, and as a curve. Same fact. So the idea is, when you look at this curve, you have two specific situations: 100% combination of asset A and 100% combination of asset B. So it is 100% asset A here, and you have 100% asset B here. The idea is, when you mix a combination of this, you also want to move up and you also want to move to the left. And that is why you see this bulge towards the left. Every investor is trying to move up and to the left at the same time. Now, at this point, I'll take you to what I say is the efficient frontier, and that was the soul of this discussion. Let's be ruthless, because half of that curve is a mistake. So if you look at what exactly is happening, not exactly half, but a lot more than half is actually just an aberration. You find the leftmost point, the gold dot, and that is where we are here. 7.4% risk, 7.1% return. That is the minimum variance portfolio of every, and you remember this term, the minimum variance portfolio, of every possible combination of these two assets, that one has the lowest risk available. You cannot go further left, nothing exists there. Now compare the two halves. Everything above that point, the blue section, is fine. As you take on more risk, you get more return. That's a fair trade. Everything below it, the gray section, is a mistake. And here's the proof. Pick any gray portfolio. Now look straight up. There's a blue portfolio directly above it. Identical risk, higher return. Why on earth would you ever hold the gray one? So what is happening? You are lowering your return and you are increasing your risk. So we throw the gray half away. What is left? The blue section from the minimum variance portfolio upward. That is the efficient frontier. And now the definition, which I want you to write down exactly these words. A portfolio is efficient if no other portfolio offers more return for the same risk or the same return for less risk. The collection of all such portfolios is the efficient frontier. Notice what that definition does. It doesn't tell you which portfolio to pick. It tells you which ones to eliminate, and it eliminates a lot. Now let's look at the risk-free asset. A risk-free asset. Think short-term government paper. Let's say it returns 4% with a standard deviation of exactly zero. Zero risk means it sits right on the vertical axis. No horizontal distance at all. Now you mix the risk-free asset with any one risky portfolio, and here's the lovely part, because one side has zero risk, that third term in our formula vanishes entirely. The maths goes quiet. What you get is a perfectly straight line from the risk-free point out to whichever risky portfolio you choose. And that is what is happening here in the graph that you have in front of you. So pick a portfolio on the frontier, draw the line, pick a different one, draw another line. Now, which line do you want? The steepest one? Because for every unit of risk you take, a steeper line hands you more return. So rotate that line upward as high as it will go until you just it barely touches the frontier. And that is exactly one point. That point is the tangency portfolio, 9.9%, 9.6% return, and that line is the capital allocation line. And let me conclude here. It's a genuine, it's a surprising one. Every investor, cautious or aggressive, holds that same tangency portfolio. Everyone. What changes between a nervous investor and a bold one is in which stocks they own. It is how much they put in the risk-free asset alongside it. Cautious, more risk-free; aggressive, less, or even they can borrow and hold more. And one optimal risky portfolio, infinite risk appetites. That idea is called two fund separation, and the slope of that line, 0.56 here, has a name you will meet constantly. And that's the Sharpe ratio. And this takes me to the systematic versus the unsystematic risk. And that's the last concept we are discussing today. And it's the one that carries you into the next session. You look at the blue line. As we add more stocks on a portfolio, 1, then 2, 5, 10, 50, 500, portfolio risk falls. Fast at first, one stock, 28% risk, 10 stocks down to 17.5. But then watch what happens. It flattens. And no matter how much more stocks we pile on, it will not go below that red floor. So risk comes in two flavors. The part that disappears is the unsystematic risk. Company specific, a failed product launch, a lawsuit, a factory fire, a CEO scandal. These events are unrelated to each other. One company's disaster is not another company's disaster. So in a large portfolio, they average out to almost nothing. You'll also hear this called, what we call this as the diversifiable, idiosyncratic, or the firm-specific risk. Same things, you got multiple names, and you will have all of these four names, they appear in exam questions. Now, the part that never disappears is the systematic risk. Interest rates move, a recession arrives, currency shocks, inflation, every asset feels these. This is nowhere to hide, so no amount of diversification removes them. Also, we call them as the non-diversifiable risk or the market risk. And in this graph, when you're looking at it, the red floor, that is a systematic risk, and it's a permanent risk. No effort that you could put in could actually help you remove it. Now, here's the question. And that's the question of the entire session. If you are carrying unsystematic risk, the market looks at you and says you could have removed that for free just by diversifying. You choose not to. Why should we pay you for a risk you volunteered for? And it doesn't. Unsystematic risk earns you nothing. But systematic risk is different. Nobody can escape it, no matter how skillfully they diversify. Bearing it is a genuine service to the market. Someone has to hold these assets through recession, and for that, the market pays a real premium in the form of higher expected return. And that lands us on the obvious next question. If only systematic risk earns a return, we need a way to measure how much systematic risk a single asset carries, and then a formula that converts that measurement into a required return. That measure is called beta. That formula is the CAPM, capital asset pricing model, and that is exactly where we pick up next session. So the key takeaways, let me summarize here. Can you compute expected return and standard deviation for one asset and for two asset portfolio? Can you explain why correlation, not the number of holdings, drives diversification? Can you interpret a risk return chart, find the minimum variance portfolio, identify the frontier, and just why the lower half is inefficient? Can you describe how the risk-free asset produces the capital allocation line? And can you distinguish systematic from unsystematic risk and say which one gets paid? If any of this is shaky, that's your revision list for tonight. The recording and all the work numbers, we're going to put it on krawl.org, on the YouTube channel of krawl.org. You could visit the video, watch it again, and get your queries sorted. Now, we have almost spent the entire time we had budgeted for this session. So if you have any further queries, I request you to reach out to us onto our email, which appears on our website, and I'd be happy to come back to you. Thank you for joining us.